what we decided to do is I've kind of got to give you a fair, balanced view of the pros for buying and the cons for buying, right? Of like what could continue to go on. And so the biggest thing just generally is the sell-off that we had, that 30% down was deep and it was swift. And, you know, relative to previous market crashes, I'm sure most of you are excited to hear that it was in the top 5, right? Yeah, not one of those things to celebrate. So when you see that kind of selling, usually that's kind of panic selling, that just straight down thing in the market. And then, you know, we've kind of been going like back and forth where as the market's recovered, it's given some people who needed to get out the ability to get out. And then as it dipped again, it gave people that are dip buyers, that's just a relative term for market stuff. The dip buyers came in and bought what they thought was value. And now we're back up again. And we'll see how today closes. But when we typically get those kinds of sell-offs, they do create, they tend to create value. The next thing is that unlike in 2008, you know, because that's the thing that's the last event in a lot of investors' minds, especially my, call them mature clients, right? That have been investing for a while, that they remember that was like the big, just kind of shot to the gut. And they all remember that it did take a long time to recover from. Well, unlike 2008, the financial system actually seems to be fairly intact. And what I mean by that is you do not have the situation occurring with the banks that we had in 2008, where all of the banks had to be bailed out because they had all just made ridiculous loans. Between the banks and the hedge funds, they had created all kinds of different mortgage loans, different types of paper and things that people could invest in. And it was a complete house of cards, and it collapsed. And so the Federal Reserve had to go in and they had to bail out the banks. And so in that situation, the problem was you know, and we had, you know, we had some of the brokerage companies go out of business. I mean, it was just crazy, you know. But unlike 2008, our financial system seems intact because they've been doing ever since 2008, they've been doing regular tests, starting I think it was 2010 forward, on the banks to make sure, you know, where they were at for liquidity and for loans and quality of portfolios and all of this. So, you know, the banks really aren't extended, okay? So that's a pro. We shouldn't really have potentially that long just recovery time that we had in 2008 because of all the pressure on the banks. Now, the other thing that's happening is current rates right now with the Fed, you know, announcing they were taking the targeted rate to 0 to 0.25, 0.25%, right? And a lot of people ask me like, why don't they just take it to 0? Well, they can't just take it to 0. Well, they could, but they really can't, because for all of us that invest in money markets, right, that money market has, even at a 0.25% federal funds rate, a very, very small yield, okay? If they took it to 0, potentially you'd have all your money markets go out of business because money markets have a cost. And that would be a real crisis. So that's why when they cut to 0.25, that's basically the equivalent, in my mind, of 0. But with rates near 0, that makes the S&P 500 dividend yield very attractive, right? It's in that 2.25%, 2.3% range. And when you compare that to for example, a 10-year bond at 1, depending on the day, right? That's fairly attractive moving forward. So that could be something that would attract people to the market. In addition, all of the data until just the last couple days, right, assumed that we were all going to die, that humanity was going to be wiped out, that we're going to have one of those, you know, sci-fi worlds with all these, you know, old rustic buildings and everyone walking around with goggles and masks and fur skins and, you know, souped up really cool guns, like Mad Max style. That would have been cool. But the point is the data was assuming we're all going to die and this whole world's going to change and we're never going to go back out again. And what we're seeing the last couple of days is, oh, we may have actually been wrong. We're not going to see, you know, 100 to 240,000 people die. It's going to be a lot less. And so the markets have been going up. because the data has been assuming that the worst is going to happen. And so if the worst doesn't happen, you know, the COVID news gets a little bit better, the uncertainty in the markets goes away, that could be a positive. And then the other thing, and this is slightly dated, I've got a little new information on this, only just because there was an announcement this morning, but we did have the CARE Act that provided $2 trillion, that's a lot of zeros, $2 trillion, that can be a good home project for the kids. If you're trying to keep them busy, be like, make $1 trillion on paper. But keep them busy for a while. You also know how smart your kids are, right? If they start cutting up little strips and counting piles of 100, they got a long life ahead of them. But the $2 trillion in stimulus, we've never seen that in a market. We have absolutely no idea. It's akin to taking a fire, maybe a smoldering campfire, because the economy is not doing that well with it all being shut down, right? Clearly, and unemployment being crazy and whatnot. But with the smoldering fire, you take lighter fluid and you dump the lighter fluid on, that fire is going to expand some way, whether it's a brief explosion, right, that burns the trees above, and the limbs and things hanging out, or it may just restart that campfire and the wet wood or whatnot that's there is suddenly engulfed in fire. So there's no way, though, that when you put $2 trillion into an economic system, that it's not going to have a big impact. You know, and so I think that, you know, that money is going to take a little while to hit, right? We all know that's not immediate. So it's going to take a little while to hit the system. But just like the Fed cutting rates, when they put $2 trillion throughout the system to work, that money is going to turn, and that money is going to help keep these businesses afloat, and that's going to help people make the bills, and that's going to help just the economy in general, and that money will circulate. Maybe not as much as a dollar under times of not as much stress, but it will still circulate. And so some of that money obviously is going to go to help with healthcare and with testing and whatnot. And so, you know, the thought is everyone's kind of debating whether when they open back up the market, but even if they open up society and say, let's leave our homes and let's go out, we still have the same problem, right? We still have the same problem, which is we can still catch this thing. Now, I'm not going to debate, what the odds of catching it are and this, that. I have asthma, so I'm being extra careful just because I've seen what it does to people with breathing problems, right? I don't need that. But at the same time, when we all leave our homes and go back out, we still don't know how to stop it. We still know that a certain part of society is at a higher risk than others. And even the younger ones of us that maybe it doesn't kill because we're in better shape or we don't have asthma. Thanks, genetics. They could still be asymmetric and they could still be carriers, and you could still get your grandparents and your older friends in your neighborhoods sick. So there is a real problem there. So while the $2 trillion will hopefully go to helping test people, whether it's temperature monitoring, whether it's, I've heard people say we want to put bracelets on people or identifiers on people, or let's sign of the beast chip everybody so we know who has it, who doesn't have it, who's cured of it. I don't know what the solution is, but until there's actually a vaccine, this economy is not going to just fire back up and function normally. But at the same time, just like that campfire that's smoldering, you can get a pretty big flame with $2 trillion. So, cons for buying. Now, the problem here that we have is, and I would love for this not to be the case, but the sell-off that actually happened from nosebleed sections. So from just nosebleed, if you're up in the nosebleed, have you ever gone to like a UK basketball game and you sat at the very top and you like look down, the fireworks even go off below you? that's where the market was. And so even though it's fallen, the market from just a valuation standpoint is not actually cheap. In fact, capitalization to GDP was, prior to the sell-off, was at a 1999-2000 bubble high. So unlike the 2008 correction, we don't have stocks that are just like screaming, oh my gosh, this is dirt cheap, you got to buy everything. For the whole market, it's just not there yet. The other thing that we have is it's going to be really tough to estimate today's corporate earnings. You've probably seen it where, Apple's come out, and I think yesterday or this morning, Starbucks came out and said, hey, our earnings aren't going to be, they're going to be this. They're going to be probably half of what they were previous year. And we're basically pulling all financial guidance for the rest of 2020. And you're going to hear that from, it's not just Starbucks. You're going to hear that from, you heard that from Costco. You're going to hear that from, we heard it from Pinterest. We'll hear it from Microsoft. We've heard it from PayPal. We've heard it from, we will eventually, I think, hear it from Facebook and Google and all those big companies, right? Because nobody has any idea what this economic bounce is going to look like. There's people that debate it all the time. Are we going to have that October, kind of V bounce that we had in October 2018? Or is it going to be more like 2008 financial, where if you want to think of it like a letter, we had the L, okay, just kind of came down and just kind of went like this and went like this, right? But just L for a while, and then eventually it came back up. Or there's other people that are debating maybe what we'll have is actually more like a U, where we've come down and we go back up, but it just takes a little bit more time than the V. The problem with all of that is there's so many people trying to figure out what these corporate earnings are going to be. And if none of the corporate companies are willing to give guidance going forward, then to go back to point number one, how do we know what the market's worth? We really don't. So the uncertainty of, the data assuming the worst for COVID, right? And as that gets better, right? And that makes people want to buy. At the same time, it's like, well, I'm not really sure if what I'm buying is of good value. So until we can lock that in a little bit more, I would expect for there still to remain a lot of volatility in the market. The other thing that, this changed a little bit today, but not a whole lot, is, the previously in 2008, the financial issues were with the banks. And now the banks are good, but all these large corporate companies, right, have taken on all kinds of debt, and they bought back their stock, which helps their stock price usually go up over time and or supports it from the day-to-day volatility we've been seeing lately. And of all things, there's even been political things going around of saying that any of these companies that get some kind of bailout, right, shouldn't be buying back shares, which I totally get that, because why would you buy back your shares and enrich your executives with your with the money that we all just loaned that company? But at the same time, for other companies that don't need loans, they've been chastised for not paying bigger dividends or not and just for buying back their stock when they could just pay bigger dividends to people and help people out with more cash flow. And the reality is that what a lot of people don't realize is these corporate companies out there are the ones that actually provide a lot of the economic stability in the markets on a day-to-day basis through their stock buyback programs. And so what we've been seeing the last few weeks is we've been seeing those companies not doing their stock buyback programs like they were for the last few years. And that's what you get. You get this crazy volatility. So if these companies and these corporate entities are unable to open for business and cannot go back in and do not have the ability to buy back their stock, then prices could be more volatile, continue to be that way. But also what could happen is that if they can't get debt issued, then you could have more corporate defaults. And I'm not just speaking about like a big company defaulting. I'm also taking it all the way down to individual balance sheets of the consumer. If you're hearing a lot of people saying, well, I under this new mortgage program, I may not have to pay my my mortgage lender for up to a year if I just claim, COVID-19 difficulties and whatnot, which is great if you don't have the money to pay it. But that's your only option, right? But at the same time, that payment doesn't go away. That's just added to your loan. And you're either going to have to pay it all back in one big chunk or they re-amortize your loan. So it's not like you're getting free money, though. You still are on the hook for making your mortgage payment. But I think that could put more people into potentially, financial default if they can't make their bills. And that's something that is a little bit different this time around. So that's something I'm worried about. Just if this, they're saying, we all go back to work here in the next, 4 weeks, 6 weeks, who knows when, right? But whenever we do, let's just assume society opens up and everything's great. Well, what happens if it continues? What happens if it comes back in November and we all have to go back in again? And we, shut down everything again, or we shut down everything to even a partial degree of what it was. Well, that first aftershock to every company and every consumer, right? Most people want to maybe rebuild their emergency funds after that first shock. And if a second shock happens and people don't have those emergency funds, that's where we could really get into some issues. And the big thing is that, we're just starting to see the unemployment numbers. And of course, the numbers I had prepared for this were based on the study done on March 14th. And then we just had new numbers come out today. But just the ones that came out last week, last Thursday, was the largest jump in unemployment, okay, that has occurred in the country since January 1st, 1975. Now that's a big jump, and that was according to TD Economics. And then, of course, the jump today was even bigger. I don't have those exact numbers in front of me, but they were giant. And most likely next week will even be bigger. And the reason they were bigger this week and most likely next week is the March 14th numbers that we looked at last week that were reported. That survey was done before, all restaurants were closed and salons and, you can't get your hair cut and gyms and just all businesses in general were shut down. And so as soon as those businesses shut down, suddenly a lot of people were unemployed, especially from the restaurant industry. That hit everybody really, really hard quick. So we're going to see those numbers, most likely continue to expand for quite some time. And we've never had a situation where, we've seen such a rapid increase in unemployment. And so we really don't know how that plays out in the cards. Now, again, depending on the type of recovery, if we have a V recovery, right, then everybody goes back to work and everybody's hired and everything's fine. If we have an L recovery, that's a whole nother scenario, right? Because unemployment stays there for a long time. And even though Costco and Walmart and Kroger's and Amazon have announced they're hiring all kinds of things, there's all kinds of jobs. If you want a job, testing for COVID-19, be my guest. My hat's off to you. Thank you, all the medical providers that are, but that's a tough place to go for your next job if you're unemployed right now, on that front line, for $12 an hour. But if you have to go that route, there are going to be some jobs that are there, but they're not going to be the same kind of jobs and the same quality of jobs that were lost, most likely. So that is a real issue that we have not really seen in the economy. Now, that said, there's been so many different stimulus packages. And in fact, we're supposed to see our Senate get back together and vote on additional stimulus packages that's kind of pending. And then this morning, we even had the Federal Reserve come out and they announced a new $2.3 trillion program where basically they can backstop all corporate debt. So what they're doing is they're basically saying for the foreseeable future, if you have a corporate entity and you need to issue some debt, worst case, we'll basically guarantee that debt. Now they can't do that forever, obviously, but $2.3 trillion is mind blowing on top of all this. It's like dumping even another thing of fuel on the fire. That should help corporate entities be able to raise the money to then keep people in that corporate enterprise employed, and therefore put less strain on the corporate entity and hopefully a little less strain on the unemployment numbers. So that's just something to look out for. And then lastly, obviously, I mean, none of us have a perfect crystal ball. I know everybody suggests that financial planners and advisors should have that. But, there is a real question of, flattening the curve, right? Even if we do flatten the curve, eventually COVID-19 is going to move through the whole population, right? And until we have some kind of vaccination for it, what does the world look like? And we may never actually go back to that new normal. It may be a Mad Max world that develops over the next few years if we never can find that fix. So, that's the outlier, that's the doomsdayer, that's the, there is no hope. But nobody has a solution yet. So that's why we're all still living cooped up. So the real question is just, in all of this, kind of wrap up this concept, is you have to understand this isn't just the US's problem. This is the whole world's problem. We're all fighting this together. We're all looking for a solution together. And we're really, if you are buying, you're simply banking on the notion that the whole world has the ability to constantly reinvent the way in which we do things and the way in which, and what we have to do in order to continue to grow, regardless of the challenges it faces. So the real question isn't whether things will improve tomorrow, because they most likely won't, right? So hanging on every bit of news, hoping that the numbers go down or this or that, I just think it's a kind of a useless activity and a waste of your mental capacity. But the question of, will things improve in 3 months, in 6 months, in 9 months, in 12 months, in 18 months, as vaccines are developed and things of this nature? My belief is that yes, it can improve, and we can, establish a new normal in society for how we deal with these kind of pandemics, because most likely this wasn't the first, right, of our lifetime. There's probably gonna be more, this is just one of those crazy things of the way the world changes. But at the end of the day, there is that Warren Buffett quote that I like to remind people of. And he actually, I believe, said this quote. I could not find the date for it, but I believe he actually said this quote in late 2008. And it was actually said before the market actually bottomed in 2009. So he was a little early to the party when he said this, but his quote was, in the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions, financial panics, oil shocks, sound familiar? A flu epidemic, and the resignation of a disgraced president. Yet, the Dow rose from 66 points to 11,497 points, which is where the market was at back then in 2008, having fallen significantly already. It would continue to fall. But his point was, even if you bought that day when Buffett, made that comment, the next decade actually worked out pretty good for you. The next 3 months, 6 months, not so great. But the point is that, there's always going to be challenges that we're facing. And, we're going to, as an economy, work through this.